Good morning. It's Monday, October 5th, and this is Joe Terril, president of Terril and Company, independent wealth managers in St. Louis, Missouri. And we are once again doing a update during these volatile market times of COVID-19. Now we have an election coming up, and we want to update all our clients and people who follow us and people that do business with us on our latest thoughts about the markets. We have been constructive on the economy and the markets since the COVID actually hit. It was an unprecedented shutdown around the world of the world economy, and it certainly took its toll on the economic activity of the entire world. We believe and continue to believe that this economic activity is coming back, and we have seen nothing in the last 30 days that changes our mind about this. Yes, tests are showing a lot more positives. There are people that are worried about what if we have another shutdown. But the key statistic that's involved here is hospitalizations, deaths, number of people in intensive care are on the downswing all over the world. The president last Friday was announced that he and the First Lady have COVID, and we will see if this strand of the virus isn't less dangerous than certainly it was 6 months ago as the president and the First Lady recover, meaning that we anticipate there will be a vaccine out, but even without a vaccine, the strand of the virus is losing its strength. All of these mean the economy around the world can continue to reopen, and as it reopens, economic activity is robust. We see this in China, where many of their economic statistics are now back higher than they were pre-COVID. We see it in South Korea. We see this in many parts of the United States, housing, auto sales. There are a lot of positives out there, and these positives are not in the United States back to pre-COVID levels, but it's the direction that they've taken. On Friday, we saw the employment figures, and unemployment was down below 8%. That's not great, but it's the direction. It's down from almost 14% in late spring, early summer, when the economies first shut down. So we continue to be optimistic, and within this scheme of the economy, we believe that the stocks that are most tied to an economic recovery are going to end up performing the best, because basically many of these companies are still down 30 and 40% from pre-COVID levels. In these industries, we put banks at the top of the list. There's great recovery potential in banks. We put the airlines in this industry. We all know what's happened to the airlines, but people are coming back to traveling. As they travel and go through TSA checkpoints, we see the figures are slowly moving higher. This is without a vaccine, without testing, and without a full recovery in the economy. But there's great potential in the airlines. Energy speaks for itself. It's been decimated by this, but we continue to own some of our energy stocks. In the meantime, we've bought chemicals, we've bought paper, we've bought stocks that also have great recovery potential. They're doing very well for us, but they have a long way to go that they can eventually recover as the economy recovers over the next 3 to 4 months. Just a couple of quick notes. We don't believe the election is going to have some major effect on the market one way or the other. Certainly, there are going to be people with strong political beliefs that may trade the market and we may see volatility. But at the end of the day, it's business activity and it's willingness of business that creates the economic activity, that creates spending, that creates jobs. That's what counts. The entrepreneurial spirit in the United States is alive and well, and as long as we have that, we'll have a good economy regardless of who's in the White House. With that said, there continues to be two investment markets. One of them is for high-tech glamour stocks, which are very risky. They've had great runs and they're up quite a bit. We don't see that as being a good investment at the moment. The stocks could fall by as much as 50% if sentiment changes and they decide to get away from glamour technology and go to something else, which is what we believe will happen, particularly as we see a stronger economic recovery. The other big issue that's going on in the markets right now and continues to be interest rates are at zero. You cannot buy any type of investment grade rated bond and make a case for the fact that you've got a great 5, 10, 15-year investment because the interest rates are next to nothing. This relates to the fact that the Federal Reserve has told everyone that they are going to keep interest rates at these levels for the next 3, maybe even 4 years. We doubt seriously if the Federal Reserve is going to be able to fulfill that promise. Reason being inflation. Inflation is beginning to move higher as we have printed more money all over the world to put into different world economies in order to help through the trauma of shutting economies down. It becomes inflationary. You can't just arbitrarily print money, put it into an economy, and not debase the value of the money that's already in the economy. So we believe that inflation that's already moved back to the 2% range will accelerate. It will move to 3, 3.5%, 4%, and it will challenge the Federal Reserve Bank in their promise that they'll keep interest rates at zero. Very difficult, cannot do this if inflation begins to pick up and move at those type of levels. So in our investment portfolios, we continue to be exposed to gold. We continue to be exposed to fertilizer and different industries that we believe will benefit from higher prices and higher inflation. So to summarize, we like the investment markets at the moment, equities that is. We do not like glamour technology equities, and we certainly don't like the majority of the bond market. There is a lot of risk, fraught with risk in the bond market as interest rates are so low that any type of movement back up in interest rates will bring the principal value of bonds down dramatically. And just on the surface of it, who would want to own a 10-year bond that is paying you 0.75% that doesn't even equal the rate of inflation? So most bonds are guaranteed losers. But we do believe the economic recovery has much more to go, and certainly most stocks and investments tied to an economic recovery have plenty of upside left and plenty of recovery potential. We appreciate you tuning in this morning, and we'll be back in 2 to 3 weeks, maybe right before the election, with another update on our thoughts during these unprecedented volatility times of the COVID shutdown. Have a good week.